Hello and welcome to The Honest Conversation. Today's missive is a stock suggestion. In the last few months, one of the largest REITs in the UK, Unite Group, has fallen from 730 pence at the start of October to 467 pence this week. I think this seriously undervalues the business and offers value. However, I am just some bloke on the internet. If you blindly follow me, then you deserve to lose all your money and be forced to watch repeats of EastEnders for all eternity, so don't do it. Another disclaimer is that you should do your own research and see if Unite fits into your own portfolio. Well then, what is Unite Group? They operate student accommodation, mostly at top universities in the UK, for example Russell Group. Some rooms they let directly. Others have medium or long-term inflation-linked agreements with various universities. Occupancy averages 97%, as there is a shortage of accommodation in most UK cities.
The high number of foreign students coming to the UK. The net asset value you get is around 990 pence per share. That's a stonking discount. I think that's good. It is rarely heard of for a large, still-growing REIT in the UK, holding useful or highly occupied property in popular cities to be this lowly valued by the market. Another way of thinking about this is to divide the market cap of 2.5 billion by the number of beds, 64,000, and you get 39,000 for each bed. Interestingly, to rebuild this REIT from scratch, getting planning permission, which would be impossible, ignoring all the challenges of setting up arrangements and agreements with universities, establishing a reputation for good quality accommodation with students and community, finding well-positioned large properties in university towns, would require around 1069p per share, per the accounts. The debt was 24% relative to assets, and the cost of that debt was 4.1%. Debt maturities are stretched out fairly equally over the next 8 years or so, averaging about 4 years, hedged to give a predictable fixed rate. So what's the catch? Changes to UK visa policy in 2023 and a reduction in student visas by 14% for 2024 were feared to trigger a decline in student intake from overseas. But notably, the Russell Group universities saw a decline of only 5% in visa grants. I think the current price of Unite Group relative to value is simply a mispricing, and an opportunity to make long-term 100% gain, while being paid an 8% dividend as you wait. Here, debt is relatively low, manageable, and low cost, compared to the sector. Maturity dates of balance are not an issue. The amount of debt used for the offer seems reasonable. Something to out the value is needed. Ongoing earnings and asset value growth in the background are always nice to see, to help build up the value pressure underneath the price. The current discount to book value is very attractive in my opinion. To be able to buy a property asset, in an inflationary environment, at a sale price, when there is a shortage of property and growing population is interesting. This is not some crappy REIT with low-quality assets. They are quality operators, with high occupancy rates and deep links with the UK's leading universities. And they are growing.
Looking at my spreadsheet again. Another way to look at valuation is the market cap you are paying per bed. It's £39,000. That's cheap. If you go out into the UK buy-to-let market and try to buy a property, not only would you be paying a lot more than that, you would be paying a lot of tax on the rental income. Unlike Unite with its REIT status, UK origin students tend to go to halls of residence in first year and pay the premium. Gives the student an opportunity to get to meet other students and provides peace of mind for parents. As students move to later years, they often find private accommodation which can be cheaper. International students, there is a large contingent of wealthy Chinese, often stay in halls of residence for their whole university life. Private landlords, in many cities where supply is tight, require deposits much earlier, and it doesn't really work well because of the late confirmation of a cost place. Another reason for the popularity of halls, as offered by Unite. The advantage of halls is the certainty of having accommodation, the shared spaces and the selection of rooms set up to cater for different budgets. I would say halls are more expensive but not hugely, and they are much more suitable for the first years and foreign students. Which had a target of 97% occupancy and missed this by a few percent in recent reporting, and they are acquiring Empiric, which only has an 84% occupancy. The dividend may also be cut. This isn't an issue for me as I assess property companies on NAV, debt and interest cover. The Empiric purchase is a small competitor, around 1/8 to 1/10 the size of Unite. Bought at a bargain price.
Consider, the bid was announced first on May 7, 2025. Unite's share price the day before was 867 pence, for a market cap of £4.2 billion. At the low of 468 pence this week, the market cap was £2.5 billion. That's a drop of £1.7 billion. The Empiric bid had a maximum value at £719 million mid-year. I just don't see how buying £900 million of net assets for a price of £719 million destroys £1.7 billion of company value. The company is currently buying back shares, and indicated buybacks are going to be the norm going forward as capital is freed up. I would expect the buyback to be extended if the price is still low in a few months' time. Expansion projects at 3 sites is being reconsidered. 3 other projects delayed. Good for buybacks, good in that limits on supply are good for rents, bad in the sense there are no cheap, easy routes to expansion. They announce the sale of property, they retain partial ownership, get £100 million cash, and continue to get paid for managing the property on behalf of institutions. Company hinting at buybacks, releasing capital for reinvestment into high-returning opportunities in accordance with our capital allocation priorities. Unite's pristine occupancy rates of the past have been impacted by lower tariff dynamics. Unite is now aggressively de-risking the portfolio by doubling its disposal rate to increase its higher tariff exposure to 80%. They are shifting their focus towards nominations agreements with universities and favoring partnerships with universities over direct developments. That reduces occupancy risk, reduces marketing costs, and reduces capex. They are using that capital and buying back £100 million of their own shares at a deeply discounted price. I think that explains the value case very well.